Unfortunately, many newly married couples start their lives together strapped with debt. Some bring their own personal debts with them to the marriage. Others start racking up credit card bills as they plan their weddings and honeymoons together. They assume that they'll pool all their financial commitments and debt included. After all, one of the purposes of marriage is the idea that what is mine is now ours. That's not always such a good idea when it comes to debt. Intertwining your finances is seen as a pledge of commitment, but financial decisions need to be made with your head, not with your heart. Paying for debts incurred by others, usually loved ones, is one of the most common reasons cited by individuals seeking credit counseling and debt management assistance. Take some time to think about the following. How important is money in your life? Is it consuming all of your thoughts? Does someone other than yourself make decisions regarding your finances? Are you concerned about your debts? What effect does money have on your relationships with family members and friends? So what can you do to make certain that you are counted among both the financially well-off and the happy? Well, as you start your new married life or are becoming part of a blended family, this could be the perfect time to revise a number of your perceptions about money. Joint checking accounts. The process of moving money from an individual account to a joint checking account is pretty standard. For practical purposes, a joint checking account is an account that lists two or more people as the holders of the account. One spouse or the couple is usually listed as the primary holder of the account. In the case of divorce or death, the account will automatically go to the surviving spouse. Couples should consider setting up all their bank and brokerage accounts in both names so that in the case of an unexpected death, you can avoid the costly and time-consuming process of probate. It's advisable for the couple to have one joint checking account and two personal checking accounts. With one joint checking account, both paychecks can be deposited into it and all bills are paid from that. This way, both people know where they stand as a couple, and it's often easier to be budget conscious. In addition, bookkeeping and account costs may be kept to a minimum because of the higher combined balance. Once married, any joint credit accounts, including those for auto loans, credit cards, and mortgages, will show up on both spouses' credit reports. One affects the other, and there's no escape from that. In most cases, you should not be liable for your spouse's credit card debt unless you sign onto a joint account. But if you live in a community property state, both spouses may be held liable for the debts incurred during a marriage. So, if you live in Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, Wisconsin, or the territory of Puerto Rico, be sure to check with an attorney. In general, though, if you keep credit cards and assets separate, the only way a credit card company might claim your assets is if money in your account represents money deposited to defraud a creditor. If one person has trouble with the IRS, consider filing separate income tax returns. You voluntarily become jointly and severely liable by signing a joint return. Also, if one spouse has bad credit, some mortgage lenders prefer that the credit-worthy spouse apply for the loan in their name only. This can be a catch-22 if the mortgage you want is so large that it requires both your incomes to qualify.